You opened a brokerage account in your 20s. You maxed out your 401k match. Every single month, like clockwork, you dumped money into an S&P 500 index fund because every finance guru on the internet told you the same thing. Just buy the S&P 500 and forget about it. And for the last 15 years, that advice made you look like a genius. But here's the thing. What if I told you that the S&P 500, the index everyone calls diversified, is actually one of the most concentrated bets in financial history right now? Not close to the most concentrated, the actual, literal, record-high most concentrated. What if the safe index fund sitting in your 401k is quietly turning into a single sector gamble wearing a disguise? Stick around, because by the end of this video, you're going to look at your portfolio completely differently. My name is Finn, and I spend way too much time thinking about personal finance and investing. If you're someone who is told to just buy index funds and chill, but you've got this nagging feeling that something's off, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's what most people don't realize. When you buy an S&P 500 fund, you think you own 500 different companies. Technically true, practically a myth. The S&P 500 is weighted by market cap. That means the bigger a company gets, the more of your money automatically flows into it. Right now, the top 10 companies in the S&P 500 make up close to 40% of the entire index, a record high. To put that in perspective, back in 1990, the top 10 were only about 19% of the index. Even at the peak of the dot-com bubble in 2000, the top 10 topped out around 27%. We are now sitting meaningfully above that dot-com peak, and it's almost entirely tech and AI-related names. So when you think you're diversified across 500 companies, what you actually own is a tech fund wearing 490 costumes. Now, you might be thinking, Finn, tech has crushed it for a decade. Why would I want less of that? And look, I get it, but here's the uncomfortable math. In the year 2000, tech concentration was already dangerously high, right before the Nasdaq lost almost 80% of its value over the next 2.5 years. History doesn't repeat, but it rhymes. And right now, we're humming a very familiar tune, just louder. Let's make this concrete. Say you have $100,000 sitting in an S&P 500 fund. On paper, that looks spread out. In reality, close to $40,000 of that money is riding on 10 companies. If just 3 or 4 of those names have a bad year, your diversified portfolio behaves like a concentrated tech bet, dropping just as hard. This is where it gets really interesting. Go back and look at 2022. The S&P 500 dropped about 18% for the year, including dividends. That wasn't 500 companies falling evenly. It was a market cap weighted index getting dragged down by the same mega cap names that had dragged it up for years. That's the trap. The label says index fund, the behavior says tech fund, and most investors have no idea because nobody reads the fund fact sheet. They just see the ticker S&P 500 and assume safety. So today, we're fixing that. We're not abandoning the S&P 500. We're building a structure around it so that when the concentration bites, you don't get bitten with it. 5 ETFs, 5 jobs. Let's go.
ETF 1. RSP, the D-concentrator. RSP is the Invesco S&P 500 equal weight ETF, and the idea behind it is almost stupidly simple. It takes the same 500 companies as the regular S&P 500, but instead of letting market cap decide the weighting, it force resets every single one of them to roughly 0.2% of the fund. A sleepy consumer staples company gets the exact same dollar weight as Nvidia. Think about what that actually does. In a normal S&P 500 fund, if Nvidia has a monster quarter, more of your money automatically piles into Nvidia and relatively less sits in everything else. That's not a strategy, that's just math compounding your concentration for you without asking. RSP breaks that loop. Every quarter it rebalances back to equal weight, which mechanically forces you to trim your winners and top up whatever's been left behind. That's the classic sell high, buy low discipline that most investors say they want to do and never actually do. Here's the honest trade-off. When a handful of megacap names are carrying the entire market, like they have been recently, RSP will lag the regular S&P 500, sometimes by a lot. But history shows the opposite is just as true. When leadership broadens out or when the megacaps stumble, equal weight has historically held up meaningfully better than the market cap version. You're not trying to beat the S&P 500 every single year with this pillar. You're trying to make sure 10 stocks can't decide your entire net worth. Expense ratio is 0.20%, a little more than a plain index fund, but cheap for what you're buying. Insurance against your own index fund's blind spot. ETF 2, SCHD, the cash flow engine. Here's what most people don't realize about a flat or declining market. If you never sell, you never make money, and in a lost decade, prices can go nowhere for years while your calendar keeps turning. Most investors have only one way to get cash out of stocks, and that's selling shares. That's called capital gains, and it's a dangerous game to depend on if the market happens to be down the exact year you need the money. SCHD, the Schwab US Dividend Equity ETF, solves that by building an internal cash flow instead. It's a bouncer at the club. To get into this fund's index, a company needs roughly a decade of consistent dividend payments, strong free cash flow relative to debt, and quality financial ratios. That screen tends to spit out the kind of company most people recognize instantly. Think United Health, Home Depot, Merck, Coca-Cola, PepsiCo. Boring, profitable, cash-generating businesses, not hype stocks. Right now, it yields somewhere around 3.3 to 3.5%, and it does that for a rock-bottom expense ratio of just 0.06%, meaning $6 a year on every 10,000 you hold. That means even if the share price goes absolutely nowhere for 3 years, you're still getting paid roughly every 3 months, like collecting rent on a property whose sale price happens to be frozen. In a lost decade, that quarterly deposit is the difference between feeling like you're falling behind and feeling like your money is still working.
ETF 3, VXUS, the escape hatch. Home country bias is the silent killer of American portfolios. Most investors have basically zero exposure outside the US, and for the most of the last 15 years, that mistake made them rich, so nobody wanted to hear about fixing it. Here's the part that makes this pillar timely instead of theoretical. It's already starting to happen. In the past year, VXUS has meaningfully outperformed VTI, something that basically hadn't occurred in well over a decade. International markets caught a real bid as the valuation gap simply became too wide for money to ignore. And that gap is still very real today. The broad US market trades at a PE somewhere in the mid-20s. VXUS trades at a PE in the mid-teens. That's a serious discount for the exact same category of corporate earnings, just sitting in a different country. VXUS, Vanguard Total International Stock, owns close to 8,700 companies across roughly 47 countries, everything from Taiwan Semiconductor and Samsung to Japanese industrials and European healthcare giants, for a razor-thin 0.05% expense ratio, basically $5 a year on 10 grand. And here's a stat that should stop you. In VXUS, the top 10 holdings combined make up around 11% of the fund. In US-only index fund, the top 10 make up closer to 30%. This single ETF is the actual diversification your diversified S&P 500 fund was supposed to give you in the first place. ETF 4, GLD or IAU, the fear gauge. Gold doesn't earn anything. It pays no dividend, it doesn't innovate, it just sits in a vault being shiny. So why do billionaires and central banks keep loading up on it? Because gold is fire insurance for your paper money. Governments printing currency is not an if, it's a when, and every dollar created dilutes the ones you're already holding. That's inflation quietly eating your savings in the background. Gold is one of the only major assets that can't simply be printed into existence, which is exactly why it tends to catch a bid when the world gets scared. In 2008, stocks fell 37%. Gold went up that same year. For the actual ETF, you've basically got 2 lanes. GLD, the Spider Gold Shares Fund, is the big, liquid, easy-to-trade option that institutions use, physically backed by bullion sitting in a vault in London, but it charges a 0.40% expense ratio, which is on the pricier side for something that just sits there. IAU, the iShares Gold Trust, tracks the exact same gold price but only charges 0.25%, so over a couple of decades, that fee difference genuinely adds up to real money. Either way, a 5 to 10% allocation here isn't about getting rich, it's about making sure a market crash doesn't turn into a full-blown life crash. ETF 5. SMH or QQQM, the controlled bet. Notice I'm not telling you to abandon tech, and I'm not telling you AI is fake. I'm telling you to size your bet on purpose instead of by accident. Right now, most investors are already holding a massive, unmeasured slice of tech through the back door of their S&P 500 fund. They just don't know how much. This pillar flips that. You choose the number. If you want maximum concentrated firepower, that's SMH, the Van Eck Semiconductor ETF. It only holds around 25 to 26 of the biggest chip companies, and it doesn't apologize for concentration. NVIDIA alone can be close to a fifth of the fund, alongside names like Taiwan Semiconductor and ASML. This is the purest possible bet on the picks and shovels of the AI build-out. Expense ratio is 0.35%. Fair warning, this fund can and has dropped 35% or more in a single rough year for the sector. If you can't stomach that kind of drawdown, this isn't your ticket. If you'd rather still ride the AI theme but with a cushion underneath it, that's QQQM, the Invesco NASDAQ 100 ETF. Instead of just chips, you're getting the top 100 non-financial companies on the NASDAQ. NVIDIA and Apple sit alongside Microsoft, Amazon, and Alphabet. Tech is still roughly 45% of the fund, so don't mistake this for safe. But if chip stocks specifically crash while Amazon keeps shipping packages and Google keeps selling ads, this fund has more places to hide. It's also the cheaper of the two, at 0.15% expense ratio. Either way, treat this slice like dynamite. 10% of the portfolio, never your rent money, and never a position you check every single day.
Here's the actual math on how this could look. 40% S&P 500 or RSP as your core, 20% SCHD for cash flow, 15% VXUS for global exposure, 10% gold, and 10 to 15%